I'm back. Apologies everyone, it is a slightly delayed weekly market update. Today is Wednesday the 8th of May 2024 and I come to you just as markets have returned to within a couple of percent of their all-time highs. So let's dig straight into it. Before I do though, you need to be aware that whatever I say is general advice only and you have to consider whether it's appropriate for you. So I guess the hot topic of discussion at the moment is economic data, and we did see some pretty inflationary data for January, February, March from the US and indeed from Australia as well. But most recently we've actually seen data take a little bit of a turn for the negative, and the markets are loving that because that says to the market that maybe inflation is going to resume falling soon. So most recently we had the US jobs report on Friday, and that actually came in worse than expected. Unemployment rose, there were fewer jobs created than expected, and wage growth was lower than expected. While this would normally be, a negative thing, and it is a negative thing actually, it's a terrible thing, the market did like it because the markets interpret it to mean that inflation is less likely. It was seen as a deflationary signal. We had a similar bit of data for Australia on Tuesday at 11:30 a.m. Eastern Standard Time when Australian retail sales came in lower than expected for the month. So they fell by about 0.4% month on month versus a fall of about 0.2% month on month that was expected. And again, not a great thing, but for the market, which is concerned about inflation, it really says to the market, well, people aren't spending, people aren't buying, maybe inflation will resume falling soon. And again, our market liked that. It took it to be a signal that, inflation might come down soon. And, as a result, the market was higher on the day. However, it actually saw most of its gains after 2:30 p.m., after our RBA spoke and delivered their May interest rate decision. Now, the RBA didn't change interest rates, and no one was expecting them to change interest rates at this meeting. So that was, pretty much a given. However, one of the reasons, or I believe the reason that we did jump extremely strongly afterwards, we rose 50 points in the afternoon after the meeting, is because they removed or they omitted the tightening bias from the statement. They did last month as well, at the last meeting as well, and they didn't have it at this statement either. And I think the market was worried that they would include a line saying further tightening may be necessary. And instead they said, we're not going to rule anything in or out. Now, if you actually read the rest of the statement, they were basically sort of worried about resurgent inflation, but the omission of that line in the last paragraph was taken as a massive positive by the market. I think the market's reading far too much into it. If you actually look at that paragraph, it's basically a cut and paste job from the previous statement, and I don't really think that means that further rate rises are any less likely, just by the content of that paragraph. Regardless, it was a bit of a sloppy job by the RBA, but the market did like it because it didn't have that tightening bias in it. It didn't have that, that line saying further tightening may be necessary. It comes after the Federal Reserve meeting last week as well, and markets rose after the Fed meeting last week as well because the market's biggest cheerleader, Jerome Powell, basically came out and said that further rate rises are very unlikely. And to be honest, with the jobs data on Friday, he does look a little bit vindicated. But at the same time, you've had very strong CPI for January, very strong CPI for February, very strong CPI for March. And at a certain point, Jerome, you're going to start to look a little bit ignorant of what's going on out there. It was the same story in 2021, 2022. He may be proven right this time around. And, like I said, the data has weakened a bit since then. However, the data up until that meeting did look very inflationary, and Jerome, you don't want egg on your face again like you had in 21 and 22. So both the central banks very positive for the market. Both drove markets higher after they spoke, and it was not that they didn't change interest rates, but it was that they basically maintained the line that interest rates are peaking. The next move will be lower, even if that rate cut has been pushed out in time. So very positive for the markets. I think a little bit of a cut and paste job on both accounts, as I said before. And I think they'll be sort of praying to their respective gods that the data does sort of weaken from here, because otherwise they'll look insanely wrong after sort of several months of remaining fairly dovish in the face of inflationary data. Finally, company earnings. We've seen the majority of the US company earnings season finalize. It's been a fairly positive season, at least for the very large companies. The large companies have, by and large, reported better than expected. There have been a few notable misses, but overall, it's been a fairly positive season for the US. We're also in a bit of an Australian company earnings season. We've seen the large banks, other than CBA, report earnings, and that's been less positive. All the banks have pretty much reported a drop in earnings, which was expected. Some of them a little more of a drop than expected, some of them a little less, but earnings have dropped, and dropped by a reasonable amount. We've seen net interest margins, one of their most important metrics, also fall, and that's basically showing that profitability of these banks is being reduced, and that's also not a particularly good thing. On top of that, these banks are trading at 20, 30, significant premiums to their broker price targets. They're the most expensive banks on earth. And so you'd think after a drop in earnings that they would be falling in share price, and that hasn't been the case. In fact, most of them are actually up since they reported results. I suspect the big reason for that is the capital returns. A lot of them had very strong dividends, increased their payout ratios, and did share buybacks. And with that capital return, that's allowed the share price to hold up at these really high levels. If you compare them to other banks in the Western world, these banks are unreasonably expensive. And if you are a banking fan, maybe you would consider an overseas bank as opposed to one of the big four. We will see CBA report a quarterly update tomorrow. What it holds is anyone's guess, but if the current reports are anything to go by, maybe they'll try and do an out-of-cycle capital return to shareholders as well. Although, like I said, it would be out of cycle and perhaps out of the norm. So let's have a look at the charts for this week, guys. We'll start with the XJO, and we can see that it basically had been on a downtrend throughout the month of April, and that at the start of May with the US Fed meeting, we sort of pushed up, and we had a strong bullish day yesterday with the RBA. Now we're sort of waiting to see if we go back to the all-time high at 7,900, or if we stall out below that level, either at 7,800 or 7,850. If we do, that'll be a lower peak, and if not, we will sort of be an inline peak if we get to 7,900. But if we exceed that level, that might be an indication that this rally is going to continue. Looking at the US market, they've also broken the April downtrend, and they've started to push up a bit as well. They stalled at 5,200 overnight, and we'd need to see them break above that level before that sort of 5,250, 5,260 looks likely. If they can, again, exceed 5,260, we're going to be on for another run higher, I feel. And I do think that, fundamentally things have taken a little bit more of a turn for the positive over the past 2 weeks. Data's weakened a bit. We've seen central banks remain fairly dovish. I just want to sort of caveat that by saying, even though things are fundamentally more positive than they were, a couple of weeks ago, prices are still insanely expensive, and if there is a bit of upside, I don't think it's going to be as sustained as it was in the sort of post-October rally. So we'll wrap it up there for this week, guys. Hopefully you enjoyed. If you did, let us know, give us some love, and we'll see you in the next one.